Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas, and I am the co-host here alongside the Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent economic news and statistics, national home sales, the mortgage rate lockdown potentially opening, more on the effects of the commission changes, and so much more. But first, like usual, Stephen, what is happening in the Thomas household?
So we're just getting in the swing of things. It's the second week of school or third, depending upon which of the kids you ask. And this is where I'm able to really dig into the numbers, have a lot of silence, and a lot of time to just dig in, look a little bit deeper, because the kids are busy at school. Of course, we have flag football that's underway. We've had 2 weeks of flag football games, and now we're just about to have the first cross country meet today. And then soccer is a week off, and we're just in the thick of everything: running, soccer, flag football. So we're off to the fall sports. And that's where we are at right now. Kind of enjoying this late August cool weather, although next week's supposed to be a barn burner. It's supposed to be really hot. So that's what's going on for us. But how about you? What's going on with Brennan Joseph Thomas?
Well, as you can see, if you're watching through video on YouTube, I'm currently out of the office. I am dog sitting, so I'm in a little new spot. So it's almost like a little vacation for me, which is amazing and exactly what I needed. But other than that, I mean, my soccer team, Arsenal, we're 2 for 2 right now. I can't complain. I'm just keeping my fingers crossed and hoping we can continue this run. And outside of that, I'd just say it's pretty much the same old for me. But we celebrated my brother, your son's birthday just last week. He turned 25. So that's pretty exciting. And we had such a great time just hanging out. And it was lovely to see everyone. But Stephen, what's happening in the real estate world with supply, demand, and our very own expected market time over the past couple of weeks?
Yeah, so we are there's a big transition going on within the real estate industry, and it's nothing to do with values, nothing to do with supply and demand, that type of thing. It has to do with the way that the real estate industry works and how compensation works. Now it's going to be done more through contracts and not through multiple listing service, and not really in the blink of an eye. It doesn't mean that all of a sudden sellers aren't paying commissions or anything like that. So at the end of the day, we're seeing that this is a big change, major change, and this major change is impacting the data and a little bit. And that's just as they figure it all out. What we're seeing is this a little bit of a bump in the inventory when the inventory looked like it was about to peak out. Then this industry change came. And so the inventory's gone up a little bit because of it. And the reason it's gone up a little bit is because demand's come down a little bit. And that's because demand is just a reflection of pending sales activity. And all the agents are trying to figure out how to decipher all the different offers that are coming in, and the offers of it's no longer offers of compensation. Instead, the buyers are asking for concessions, and so that's where they have to figure it all out. At the end of the day, we think the market's just going to work itself out, and it's just going to be a moot point. But we're seeing it in the data. So we see inventory going up a little bit, demand coming down. So the markets actually were starting to slow down, speed up. They were getting a little bit faster because interest rates have still remained actually a little bit below 6.5%. So we were higher for most of the year. We were at above 7, and then even 7.5%. So 6.5% was driving demand, and it was slowing down the inventory rise, and the markets were actually heating up. But now over the last course, the last couple of weeks, we've got a reversal. Instead, we've got increasing inventory, slowing demand, and now the market is slowing a little bit. Actually, there was a kind of a bump in the slowdown, and it doesn't mean that we're moving towards a buyer's market. It's just a hiccup in the data. So looking at the data right now is not going to give you an accurate reflection for what's going on in the marketplace. It's only a temporary thing, but this is something that this is the one time I can actually say that if you look at current data right now, you can't really chart a course currently, but that will ultimately change, and we'll talk about that a bit more. But that's where everything's at right now.
So, what has happened with the economy over the past couple of weeks?
Not much. Really. It's been like a yawn fest, big yawn. It was like taking a nap. Everything's been right in line with expectations. Nothing's been out of whack. The Federal Reserve, they met. They do the Jackson Hole, Wyoming Economic Symposium every year. They came out, and the big thing out of that was that Jerome Powell set the stage for the rate cuts that are coming in September. Now, everybody thinks it's absolute certainty that it will be a quarter point, not a half point, but it really depends upon next week, actually, because next week is jobs week. We're actually recording this Friday, August 30th. Next week we get job openings, and then we'll get ADP payroll. That's independent payroll, and then we'll get the actual jobs report and unemployment on Friday. That's a huge day that will move markets. And if we have unemployment kind of like we did in the beginning of this month, looking back at July, that is way lower than expectations. I can imagine it's going to move the Fed to do a 0.5%, or if we see a big jump in unemployment, or both, definitely 0.5% change in September. They don't really want to do it, because ultimately what's going to happen is we're going to get we have an election coming up, and there's going to be a lot of people saying election interference when it has nothing to do with the election. It has more to do with what's really going on with the overall economy. They want to wait until after the election, the day after the election, is when they meet next, beyond September, and so they can make their 0.5 point change then if they would like to, and they'll have even more data by then. So and then today out came PCE, that's personal consumption expenditures. That index is another inflation index, very similar to CPI, except it's a little bit better of a CPI inflation read. Doesn't have as big of a shelter component, has the similar shelter components of owner's equivalent rent, which is broken, but it's not as big of a component, so it's not as big of a drag on the inflation index. And it came in right in line with expectations. And if you extrapolate out the change from month to month, we're right at 2%. If you pull out if you look at fuel and food, pull out that and do core, it's looking like pretty much right at 2%. So it's inflation's where they want it to be. So now they are too restrictive. They're going to be looking at what's going to happen with labor, and if that cracks too much, that's where they've got to make a move. And the moves could even be bigger if the cracks get bigger, because our opinion all along has been they've been waiting too long.
So, an interesting headline that I saw that made me think of the people that are continually calling for a housing crash is 1.8% of all mortgages in the US have negative equity. Is this a headline or what?
That is really, really low, because there are people that do various things, get other loans on it, and there aren't that many lenders that are even going to lend a second mortgage where they have less than 20% equity in the house. But you can imagine that there will be some lenders that do it, that some private lenders, that hard money loans that will be put up against a property to take for business purposes and things like that. That's where you're going to even arrive at that 1.8%. There might be a handful of people that are left over from the great financial crisis of 2008. 1.8% is nothing compared to where negative equity was in the past. This is a big giant yawn fest. 1.8% negative equity. This is not a headline. It's a headline of how ridiculously low at negative equity is. So if anybody wants to look at this as an issue, They're scratching for whatever they can find to support their ridiculous claims of that the whole world's going to be coming to an end at any time. That's why I can't read comments on X. That's I was talking to you about it. I can't read comments around any YouTube. It gets ugly. It's a lot of guys. There are some gals in it, but it's a lot of guys. This is just what they do. They like to talk about how everything's going to come to an end, and they're so negative all the time, And a broken clock is right twice a day. I mean, this is kind of that mentality that eventually some of these people are going to say that they're going to claim that they're right, but they've been talking about it for so long that they've been wrong a lot more than they've been right. So I just don't pay a lot of attention to all the negativity that's out there. And this is just one of those. If they take that headline and say that it's a problem, there's your problem, is the people that are making an issue of this.
The housing inventory in Austin is at its highest rate in over a decade. With rates continuing to drop, can we expect the market to have a turnaround at any point in the near future?
Yeah, there's areas of Texas and Florida, and there's a few other areas in the country that are actually seeing more inventory than where they were in 2019. Part of it also is they built so much as well over the course of these last 5 years, because there's been a lot of building going on, but there hasn't been a whole heck of a lot of building going on where we live in the state of California. So this too is just another one of those stories. Inventory has grown definitely year over year. We've seen it in all markets. Where it's grown in leaps and bounds are those areas that saw the biggest uptick in values, and now they have more inventory. So yeah, there's going to be small pockets of where there could be issues, but not as when rates start coming down. That's not going to be that much of an issue. So rates dropping will just increase affordability, which will increase demand, and so that will be the ultimate fix for these markets. That's really what's keeping these markets from being a lot hotter across the United States, and especially these that are slow are rates at where they're at. Because if you look at the median income of people in those areas, it's just outpaced the median income by a lot in those areas. A lot of people that live in those areas can't afford to even purchase in their own backyard now. They've been renting, so that causes stress and different things like that. But the real fix to that is values to come down, which we're not really seeing that in many different areas. There's a little bit more pressure in those areas, but once interest rates come down, home affordability comes back, and now you're going to pour into demand. More buyers in the marketplace will just shore this up. Now in hotter areas, now you're going to see values go up faster. But what you see in areas like Austin and Florida, you'll just see that you're just not going to get as much pressure for prices to come down. As a matter of fact, probably see the opposite. Values starting to rise again in those areas.
According to the Federal Reserve Bank of Minneapolis, non-mortgage costs were 40% of the housing budgets through 2021. In this instance, is housing the only affordability issue that needs to be solved, or does it shed light on a larger issue at hand?
It does shed light on a larger issue, because now where you see it immediately is in areas like real estate. We saw a crash. The crash that everybody wasn't expecting was just in the number of units. So there was a giant crash in units immediately, because we went from 3.25% interest rates all the way up to 7.37% in 2022. And then in 2023, they reached 8%. And in 2024, in April, they reached 7.5%. These are really high rates. And I know we've had rates that were higher in the past. However, you plug in these rates to what everybody's been accustomed to is lower rates. Now you plug these rates into these higher values of houses, the median sales prices, and it just makes things just absolutely unaffordable. So that was immediately going to happen. So that's where everybody sees it crystal clear. But what it doesn't illustrate is but behind the scenes with the Federal Reserve being too restrictive with their short-term rate. Now we're not talking long-term 30-year mortgage rates. We're talking the short-term federal fixed rate being at 5.5%. There's a lot of things that are stuck to that, like equity line of credit. So people that pulled out money, all of a sudden their equity line of credit goes up. Their monthly payment goes up, and when you go from where it was at close to zero, the Federal Reserve, to 5.5, you're going to see these equity line of credit, which are benchmarked based upon that, they're not at zero, but then you could see that they'd be really low and they'd go up really high. So anybody that had an equity line of credit was seeing that immediately, as well as automobile loans, as well as credit card debt. So credit card issuance has been a problem. So it shows that them being too restrictive has issues with other areas of credit, such as credit card. You're talking about middle to the lower income levels. Those will be impacted quite a bit by the stress of higher rates if they're carrying a balance, which a lot of people are. So we're seeing credit card delinquency stress, quite a bit of it that's out there. And that is an underlying current of a slowdown. And then there's also all of these business loans, and anybody that has big commercial loans, real estate loans, that they get them fixed, and they're only fixed for a certain number of years. And then at that point, they have to go out and get a brand new loan. And when they go out there and get a brand new loan, because it's not fixed for 30 years, you pay it off and now you're done. That's not how it works. You just have to get a new loan or pay back the loan completely. And so what they have to do is slowly but surely over time, what's been happening is a lot of these people, their loans are done, and now they got to go get out a new loan. And they had a loan that was really small with a small, interest rate with a low interest rate, and now they're looking with a low payment. Now they're looking at a much higher interest rate with a much larger payment, which just affects their P&L, and it's creating stress in the commercial sector, as well as for these smaller banks. We've had banking issues in the past. It creates more stress for these banks as well. So there's a ripple effect in the economy that you just don't see the thread. You see it immediately in real estate, which we saw. But there are many other aspects with keeping things as restrictive as they are, like the Fed is. They're risking causing more damage the longer they stay elevated. And that's their problem. It's like when they do adjust, they're so late, and they just did it again. We've talked about it before that they need to do it. So they really should have gone a quarter point back in July, and then they should do a quarter point in September. Since they didn't go in July, they should be doing 0.5% in September, but consensus is it's only going to be 0.25% at this point. But we'll have to see with the jobs reports that come out next week. That'll be a really good, strong indicator as to what the Fed will do the following week.
So what I wanted to ask is, did the new rules for the real estate industry just make the sales process more complicated rather than making the home purchasing process cheaper?
Yeah, it did make it a lot more complicated at first. When I think it's like a California Association of Realtors, and a lot of these different associations across the United States, the various state associations. Like I know that there's like 200 forms, and there was revisions of so many of them, and the revisions were major. They were major because they really changed the way compensation, everything was done. And they needed to make sure that everything looked really great, because the Department of Justice is going to be taking a look at this, DOJ. And it's not just the attorneys, but then the federal government is getting their hands in this, and they're making sure everything is adequate. And it looks like Department of Justice is just waiting for various entities to mess up so they can jump all over it. So it's caused a lot of friction. I've actually heard out in the street that there are faux buyers that are going through open houses that are actually pretending to be consumers, and they're recording it, the whole entire process, trying to trip up agents to do things that they shouldn't do so that they can be sued. Part of more lawsuits to follow. It's just, there's a lot of predators that are out there. You just have to be so careful with this giant change that you just have to do everything by the book. And so it's really kind of like slugging. It's like it's gumming up the gears right now of the way everything is working. So this will work its way out. It's just not going to happen immediately.
So people were asking almost immediately if and when we would see the effect of the recent changes. So, Stephen, would you mind breaking it down and how it relates to the lending changes, which I believe happened in 2015?
Yeah. So yeah, I had somebody ask. It was like 3 days after it changed. I thought, I think it was Monday or Tuesday, and it happened on in the middle of the month. I think it was Saturday, the 17th or something like that. Yeah, Saturday the 17th. So August 17th, it went and somebody asked me like Monday or Tuesday, "Hey, do you see anything in the data too soon?" But we definitely see it in the data now. That's what we talked about. So it's definitely gumming up the way things work, and they know it because they're out there trying to enact all this stuff. They've got to meet with all their buyers, get them under a buyer contract prior to even writing an offer, showing homes, anything now. Every single buyer, and most people didn't have buyer contracts with their buyers. I mean, there's a lot that do. So now everybody has to have a buyer contract. So now you have to go out, you have to sit with everybody to explain this whole entire thing. And the explanations will only get better. And they'll only get everybody will be able to articulate what's going on. And it's going to weed through. Some of these people have a hard time articulating what's going on because they don't understand it very well. And now they have to go turn around and try to understand it. And what this is going to do, it's going to weed out some of the agent population. It's going to be, everybody says that, they have this idea of the way the real estate professionals are. This is going to just make the real estate profession even more professional at the end of the day, because it's going to take people that can really articulate what's going on, that can handle all these myriads of contracts, explain the whole entire process, and then get it done. So that's not going to take a second to figure out. I mean, there are people that this is just business as usual. I talked to a real estate agent today that said, yeah, no big deal, business as usual. But there are others that will have a hard time with this. And this reminds me of a big lending change in 2015. It was called TRID. That's the short, the acronym for it. But I'm not even going to get into what that abbreviation for. It's TRID. And they had this giant change. And I remember that lenders were they couldn't believe they had to go through this whole entire new process. It was basically came out of the Great Recession, and there had to be a complete disclosure and a different way of doing things. There's all these disclosures that went out. And so it was a big revolutionary change in the entire process of lending. And people said that this was just going to muck things up. You know what it mucked up? It mucked up the closed sales. The closed sales, immediately we saw closed sales come down. And then the following month, we saw, after everybody got it all on, they figured everything out. A month later, it was back to business as usual. That is exactly what I think is going to happen this go around. After about 30 days of working with us, talking to all their buyers and talking with sellers, and everybody's going to understand it, this thing's just going to work itself out. And in the end, not a lot is going to change. Not a lot is going to change within the industry. It's just no longer can you see the compensation in the MLS. Now everybody's going to know how incredibly negotiable everything is. And then at the end of the day, to negotiate things, either you're going to pay a buyer's agent compensation, or there's buyers that are going to say, sayonara, if you're not paying anything, I'm going to the next property. And it will just limit the number of true offers that a lot of properties do receive. If I was an agent, even if they said they were going to pay zero, I still would write an offer and ask for buyers concessions for the buyers, and then that's where the buyer's agent compensation will come from. And if they say no, they say no. We move on to the next property. It's kind of like the whole negotiating process. So in the end, because here's what the funny thing is, these sellers are going to sell, even if they say that we're not paying anything. Now they're going to go buy something. Are they going to ask for some concessions when they do that? Most likely. So what? They don't want to pay it here and they don't want to pay it there. That's been the way that everything's worked for a long time, and I've seen it over time. What ends up ultimately happening is you pay it on the sell side because you have you have the equity to do it, you have the appreciation to do it, so you're able to pay the concessions and your listing agent's fee, and then you turn around and you go purchase something. And when you purchase something, you don't want to have to pay that stuff. So you just negotiate the concessions and all that stuff. So at the end of the day, it's not going to change much. But I'm telling you, this first initial month, when everybody's trying to figure it out, we see it in the data, but that's about as long as I think it's going to last. Maybe a little bit longer. There will be some choppiness because of the magnitude of this thing, but it will be business as usual for sure in 2015. Everybody will have this down. This is not the first time that the real estate community has had to rally and figure out how to redo business. They did it in COVID. COVID was a major, major hit when all of a sudden you couldn't show a piece of property, and then slowly but surely there was the ability to show properties, to write offers, and one person could go in at a time. Everybody had to be masked up. They had to have a hazmat suit on. There was this big giant these different forms and contracts that were posted at doors that explain the whole entire process. I mean, it was really, they figured out a way of doing it. They went through the exercise of actually doing it, and business went on as usual by the time we got to the middle of May 2020, and we shut everything down in April.
It's crazy to think that that's a couple of years ago from now.
Yeah, it's a long time ago now. I mean, shoot, I was just thinking that myself. That was more than 4 years ago.
Yeah, that's crazy. So a recent listener asked, after the recent job adjustment, how do the adjusted job numbers factor the market projections, or is there any impact?
The only impact in this is it's exactly what we said, that the economy has been slowing down. It's still, we're at, like, I think it comes out to, I can't remember it off the top of my head, is about 135,000 jobs we were adding every single month. That doesn't sound like a struggling economy. It's just not as robust as when we were first coming out of COVID and the number of jobs that were created. So 135,000 per month. The issue is, where does it go from here? And you could already see after massaging it that it wasn't quite as good as what they originally had anticipated. And going forward, if they keep things restrictive, it will only cause further damage. And you just don't want those numbers to get too low. You get those numbers too low, now you have a problem. Now you have a recession, and that soft landing is out the door. And I heard one of the ex-Fed presidents on CNBC today talking about soft landing done. We've done it. So they're going, boy, then they better do the rest of their homework, and that is cut these rates, or soft landing blown, hit the tarmac really hard, and now you caused a recession. Way to go. So that's what needs to be avoided. Can they do it? We'll have to see.
So at the end of last year, the National Association of Realtors forecast that sales would rise by 13.5%. That estimate predicted on falling mortgage rates appears to have been optimistic. The July existing home sales report showed that sales were down 2.5% year over year. With lower rates, can we expect a better second half of 2024?
Well, we're well into the second half now. It's like the last 4 months. Let's call it the last third. And and this has everything to do with the Fed. We're in the same camp that we thought that it would go a little bit earlier. We thought that the Fed's rhetoric would change. Once you started seeing the numbers, it took them a lot longer to come around. And it wasn't until they saw some really deep fissures, and that was in starting with the jobs report for July, which came at the beginning of this month. All of a sudden they're freaking out because they had just met a couple days prior. This thing came out, and now they knew that they should have already gone. So that's been our issue, is they should have already gone. They should have already orchestrated. They didn't. So that we didn't get the rates come down as quickly as what everybody had anticipated. So should it? We're getting these more favorable rates, but it's also coming at the time when we're having this real estate industry change as well. So that's also punting it even further. And who thought that would be the outcome of doing it, that there would be some, that it would affect some pending sales and closed sales activity. So there's going to be a little asterisk around these closed sales numbers. going forward because of this real estate change. So can we see more? I think we're going to start to see a bit more activity, especially by the time we get to like the fourth quarter, and that's when we get into October. That's where we're going to see it. But then but that's when we have a dwindling supply. So you have a dwindling supply. That's not where we have dwindling supply and demand coming up. That doesn't equate to a whole heck of a lot of extra sales. There will be a bump. It's not hard to beat year over year last year, 2023, from September on, because man, interest rates got all the way up to 8%, and it really slowed things down considerably. So it won't be hard to beat year over year. It's just right now, when we looked at it, it's basically almost the same. I mean, we might be up 2% for sales. We thought it would be a little bit juiced up by the time we get to the end of the year. Yeah, it's going to be higher, but that's what it's going to really set up is a great 2025, because it'll be easy for 2025 to beat 2024 with lower rates that are here to stay, that will continue to drift lower and lower and cause even more demand. So that's to come. We're just not going to get a lot of it for the remaining third of 2024.
In the second quarter of 2022, 93% of mortgages had a mortgage rate below 6%. In quarter one of 2024, it was 86%. Although a 7% difference between the two percentages may not sound like much, what does this figure actually tell us, and are we able to feel it in the market?
Well, this says that there were some homeowners that were moving on, and there are more homeowners that were purchasing with these higher rates. So they have these higher rates. It's now, if they keep on purchasing at 6% or higher, that's gonna make the overall number that are 6% or below continue to drift lower and lower. Although as rates continue to go down, now we're at 6.5%, but once they get to 6%, that number is still not going to change. So we're finally getting to a level where more people will be able to. We'll start then focusing on the number below 5% and not necessarily below 6%. And that number, there are more people that can afford. I'd say that what that indicates is anybody that has an interest rate above 4% is more inclined to list their home, and homeowners become sellers, and they turn around and become buyers. And so there will be more of a churn. There'll be more homes coming on the market, because that's been the problem, is the number of people that are landlocked. They just can't, they don't want to move because they're enjoying such great low rates. So people have called them golden handcuffs and all that stuff. It's just common sense. They're paying way less. They don't want to exchange their low interest rate for a higher interest rate, even if they can afford to do it. A lot of people just don't want to do it. So, but as rates come down, it opens up the door for more of that to happen. But so this is a step in the right direction. That's for sure. But you can't really feel it in the market yet. We're going to see it more as rates float down more. You'll be able to see that more people will be able to move.
According to an article written by Yahoo Finance, there are two signs of a potential bottom in the market for the commercial industry. One being the transaction volume has stabilized and increased slightly over the past 3 quarters. Another is things have to get worse before they get better, with Moody's economists seeing seller capitulation. Would you agree with this? Have we seen the bottom of the commercial industry, or is there more possible pain to come?
Yeah, this isn't necessarily. I like to. I'm gonna semi punt. This isn't necessarily totally my lane. I follow a lot of things. I have followed this. I've actually listened to Moody's economics quite a bit. They have people that this is what they do. They're pretty much commercial economists. But listening to them, yeah, it's one of those things where you think you might have reached a bottom, but can it go further? It possibly can. What I'm worried about more than anything else with commercial is that it hits this bottom, but then continues out at that bottom. That does not increase. It's kind of like the doldrums of the way that the real estate market's been, but commercial has more issues, especially in the commercial office space. That is a real problem. So I can't see that all of a sudden resurrecting and going up. I could see this flatness, like what the residential resale market has been experiencing for now 2 years. It was August of 2022 where we bumped above 6%, and we've stayed there. And it's really just slowed down our marketplace completely. And it's not hard to go up from where we're at. Same thing with the commercial market. Once you're at the doldrums of those low benchmark, it's not hard to beat that benchmark. So, but I think they're going to be traveling along this bottom, this base for quite some time.
All right. Well, thank you everyone for tuning in to another episode of Let's Talk Housing. This concludes episode 30, which is crazy to say. So thank you so much for tuning in. And if you want to learn more about what is going on in the real estate industry across Southern California, Bay Area, Phoenix, or Vegas, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. We would greatly appreciate it. And if you have any questions, feel free to post it to any of our social media platforms, or you can even email me at info@reportsonhousing.com. We will see you soon and have a fantastic rest of your day. Thank you.
Thank you.